Let's start with the conclusion. AstraZeneca is not just having a good week. It is consolidating a position as arguably the most diversified late-stage pharmaceutical pipeline in the world right now. But here is the tension that most coverage is missing entirely. When a company executes this well, for this long, the risk stops being about the science. The risk becomes the price you paid to own it. Here is what happened, and why it matters more than the headline suggested. On Friday, AstraZeneca shares gained 3.41% on the London Stock Exchange, outperforming a flat FTSE 100 that ended the week essentially unchanged. The catalyst was the readout from 2 phase 3 trials, the Oberon and Titania studies, evaluating a drug called tozorakimab in chronic obstructive pulmonary disease, or COPD. The results showed a meaningful reduction in the annualized rate of exacerbations, compared to placebo. Now, if you are not familiar with COPD drug development, that sentence might sound routine. It is not. Here is what most people watching that 3% share price move did not fully appreciate. COPD is the third leading cause of death globally. It kills more people than breast cancer and colon cancer combined. And for decades, the biological mechanisms driving it have resisted the kind of targeted therapy revolution that transformed oncology. The existing biologic options on the market largely address inflammation through one pathway. Tozorakimab works differently. It inhibits both the reduced and oxidized forms of IL-33, a signaling protein that drives not just inflammation, but also the cycle of mucus dysfunction that makes COPD so debilitating and so deadly. Sharon Barr, AstraZeneca's Executive Vice President of Biopharmaceuticals R&D, described these as the first 2 confirmatory phase 3 trials for an IL-33 biologic ever. In the history of COPD drug development, that is a first. The market priced it as a Good Friday. It may deserve more credit than that. But here is the part that deserves even closer attention, and this is the point most analysts are treating as background noise. In the same week, reporting confirmed that AstraZeneca is actively expanding its research and development footprint inside China, alongside Sanofi. And separately, AstraZeneca published findings from its choice survey, targeting real-world drivers of EGFR inhibitor use, also in China. 2 China-facing data points in a single week, from different parts of the business, is not a coincidence. It is a signal about where AstraZeneca believes its next decade of growth is anchored. China is simultaneously AstraZeneca's greatest growth engine, and its most complex geopolitical exposure. The company has built one of the deepest commercial presences of any Western pharmaceutical company inside the Chinese market, across oncology, respiratory, and cardiovascular franchises. EGFR-targeted therapies in lung cancer, for instance, have unusually high penetration potential in China, because EGFR mutations are significantly more prevalent in Asian non-smoking populations than in Western ones. When AstraZeneca runs a real-world evidence survey on EGFR inhibitor usage patterns in China, it is not doing academic research. It is building the data infrastructure to defend and expand market share in a segment where its drug Tagrisso is already a category leader. That is a commercial operation dressed as a scientific study. Most retail investors never connect those dots. Now layer on top of this the EU approval of Imfinzi, AstraZeneca's PD-L1 checkpoint inhibitor, for early-stage gastric and gastroesophageal junction cancers, which was announced in the same week. Gastric cancer disproportionately affects Asian populations. An EU approval in this indication often precedes or accelerates regulatory review in markets like Japan, South Korea, and China. So the Imfinzi gastric approval is not just a European story, it is a strategic piece of AstraZeneca's Asian oncology franchise, moving quietly in the background. Now let us talk about the tension that makes this stock genuinely difficult to own with conviction right now, even if you believe in everything I just described. AstraZeneca carries a consensus analyst rating of moderate buy. That is not a ringing endorsement. Moderate buy, in analyst language, often means, we think the science is real, we think the management is executing, but we are not sure the current price gives you enough margin of safety to get excited. And that is the core paradox here. The better AstraZeneca's pipeline performs, the more phase 3 wins, the more regulatory approvals, the more China expansion, the more the market bids the stock up to reflect that future. At some point, you are paying today for growth that will not arrive as revenue for 3 to 5 years. The in-licensing announcement, AstraZeneca securing worldwide rights to a phase 3-ready novel chemical entity, adds another layer to this. The company is not slowing down, It is adding to the pipeline, even as existing assets are crossing finish lines. That is a sign of management confidence in capital allocation. But it also means the market is continuously being asked to value an expanding set of future optionality, rather than a simpler stream of near-term earnings. Here is the reversal point that changes how you should think about this. The conventional risk narrative around AstraZeneca right now centers on China revenue exposure. The concern that geopolitical friction, pricing pressures from China's volume-based procurement system, or regulatory headwinds, could impair the company's most important growth market. That is the bear case most people have heard. But consider the counter-reading. AstraZeneca is not retreating from China. It is doubling down with R&D investment. And when a company of this sophistication expands R&D presence in a market that analysts are warning about, it usually means they have visibility that the public does not. They see a regulatory or commercial pathway in China that makes the risk worth taking. The bear case assumes China becomes a headwind. AstraZeneca's behavior suggests they believe China remains an accelerant. So where does this leave investors? And what are the two paths from here? If the tisorakimab program converts its phase 3 data into a successful regulatory filing and eventual approval, and if Imfinzi continues to expand its labeled indications in gastric and other solid tumors, then AstraZeneca is building a respiratory and oncology franchise that has genuine blockbuster depth across multiple disease areas simultaneously. In that scenario, the current valuation premium is not a trap. It is the price of owning one of the few companies in global pharmaceuticals with this kind of multi-wave pipeline execution. Investors who bought the science early get rewarded not just once, but in successive approval cycles over the next 3 to 5 years. But if China-related revenue comes under pressure, whether through government pricing interventions, procurement system dynamics, or broader geopolitical friction, and if any of the late-stage pipeline assets encounter unexpected safety signals or regulatory delays, then the arithmetic of the current premium becomes punishing. In that environment, even excellent science does not protect you from multiple compression. The stock is priced for execution without error, and pharmaceutical development, by its nature, does not work that way. The honest assessment is this. AstraZeneca is executing at a level that very few pharmaceutical companies achieve in any single year, let alone across multiple programs simultaneously. Tisorakimab is a genuine scientific first. The China expansion is a calculated bet by people with better information than most market participants. The Imfinzi gastric approval is quietly building a pan-Asian oncology franchise. These are not small achievements. But none of them change the fundamental investor question, which is always the same: what price am I paying, and what does the future need to look like for that price to have been right? The pipeline momentum is real. Whether the valuation reflects that momentum accurately or exceeds it is the only question left worth asking.